Bazaar Morning Call, live from the CNBC-TV18 headquarters in Mumbai.
Hello and welcome to Bazaar Morning Call. I want to wish all our viewers, especially those from the states of Karnataka, Andhra, Telangana and Maharashtra, a very happy New Year. I can manage it in Marathi. Amsa Marathi Darshakanna Maza Hardik Shubhechha.
I'm glad you could manage it because I don't think me or Anuj could. But yeah, Happy New Year to all our viewers. It's Gudi Padwa tomorrow.
I think it is Nutana Samvatsara Shubha Kansalu in Andhra, in Telugu. That's all I know.
Okay, multilingual, not bad.
No. Well, I have some relatives in Hyderabad. Okay, well, just to get back to brass tacks, the important point today is that we've got 2 days in a trot of FII selling. So we perhaps have to take note of that a little more because that was the big engine fueling the market. Also, it's a tired bull. We've seen a 1,100 point jump in the Nifty. That'll work out to about 12-13% in a matter of 6-7 weeks. So at some point in time, there will obviously be some bit of profit taking. Now, for me at least, the question is where does the Nifty find support? I guess the screen will have to tell us, or Anuj will have to.
Yeah, okay. Well, before that, Lata morning, Anuj morning, it is the global markets have also been quite upbeat, right? 6 days on the trot now. The S&P 500 has closed in the green. And we did get some news this morning. The Chinese premier saying that a new consensus has been reached on trade between China and the US. So perhaps there could be more of an upside in the global markets. A couple of Asian markets, though, are shut for trade today. Hong Kong, Taiwan and the Shanghai markets are all shut today. So not too many cues from across the globe. But Anuj, what's the sense you're getting about how to approach trade? We have come off a little bit from those all-time highs of 11,760. You think it's just a matter of time before we sort of scale new heights again?
Morning, Sonia. Morning, Lata. Look, my base case was that around policy day we'll have some kind of culmination of the current rally, which will be just a pause and not a full stop. This policy actually was quite good, I would say, and if it was extreme policy, perhaps I could have said the markets made some kind of top, but because it was not 50 basis point and not all out dovish, I think it's left some room. The market's catching its breath after what's been, like Lata described, a big rally, 11-12%. All I would say is there's nothing unusual or sinister about this fall over the last 2 days. It's normal. Also, the Nifty is at 11,600 now, and the 20-day moving average, which is rising, is at around 11,437. So, Sonia, this is about 160-point difference between Nifty and the 20-day moving average. My sense is that perhaps some more consolidation on the Nifty, some more catching up of the 20-day moving average, and you will get a fresh buying opportunity on the market. The Bank Nifty has corrected 2.4% from its highs, and on the day of the Nifty hitting new high, the Bank Nifty did not. But the Bank Nifty had already been hitting new highs almost on a daily basis. So some money is being taken off. Even on the Bank Nifty, we are at 29,900. The rising 20-day moving average is at 29,430. So perhaps 1 or 2 day more consolidation, some more decline, you get fresh buying opportunity. But the trend that we spotted early last week, there's money rotation happening in large caps at all-time highs. This week, HDFC is up 4% and HDFC Bank is down 1.5%. HDFC is seeing buying, HDFC Bank is seeing selling. Indiabulls Housing is also up. ICICI Bank, IndusInd Bank, Yes Bank, Axis Bank are all down 2 to 4%. So there's some bit of money rotation happening, which is healthy for the market from banks to NBFCs. And that perhaps was the policy trade, perhaps has some more legs to go. Let's see. Overall, this is a market in which perhaps you will still make more money by buying the dips, but this was one correction or one small consolidation that the market needed after this one-way rally that we had.
But is 11,600 a decent support?
I don't know. I mean,
yesterday, or for the last 2 days, our technical experts have been giving support levels around 11,600, 11,620.
Yeah, see, the yesterday low was
570, I think.
Yeah, somewhere around that. So after that, we had expiry pullback. I think for me, the sacrosanct support really would be somewhere around 11,500, because what that would mean is by the time, if the Nifty goes there, by that time the 20-day moving average would have also caught up, and in a in a fresh bull market, perhaps that's all the correction that you will get, around 250 points, thereabout. And after that, the market perhaps would be ready. By then, would have enough shorts as well for perhaps a fresh up move.
Nice round figure, 11.5.
Yeah.
Okay.
Okay, well, this week has been exceptionally good for a lot of stocks. Especially some of these auto names. So Tata Motors, for example, has gone up almost 20% this week. Even some of the telecom names have had it good. So names like Bharti Airtel up almost about 8%.
No, just a word on this, Anuj. We are also on the start of the earnings season. So if that throws up some nasty shocks, I don't know whether,
True.
you know, the street or the screen will have to make up its mind at that time.
True.
Whether you take it badly, whether you take it well. And then, you know, there will also be all these election surveys that will keep coming in. So there could be many things that can buffet the market, both the bulls and the bears.
Okay, well, we'll keep our eye out on both sides. But for now, let's take a look at what our wise experts have to say as we head into trade this morning. Neelkant Mishra of Credit Suisse says the economy continues to slow, driven by monetary tightness, as M3 growth continues to lag GDP growth for banks, reflecting the lack of money creation. With no room for a fiscal stimulus, the MPC's caution on rate cuts keeps them concerned about growth.
Okay, some more equity advice for you. Mahesh Nandurkar of CLSA says it was the second straight policy rate cut by the Reserve Bank and downward revision in CPI and GDP growth forecasts. This implies that the market will continue to hope for more rate cuts going forward. They believe the moderate inflation environment is here to stay as food productivity continues to inch up. A few domestic and international agencies have raised monsoon concerns due to El Nino. But CLSA's empirical analysis shows the rainfall deficiency doesn't impact inflation. He says the RBI has room to cut by another 25 to 50 basis points over the next few months. CLSA continues to be overweight private financials and they prefer ICICI Bank, Axis Bank, HDFC, while they place Colgate with Ramco Cement in there. Okay, they replace Colgate with Ramco Cement in the model portfolio. I just want to say a word. The Reserve Bank releases a monetary policy report along with the April and September policies. There they say if the monsoon is deficient, inflation can go up by 50 basis points from our base case. So there is a model estimate of that. I don't think we can be very sure that there won't be an inflation impact. But then we can't even be very sure whether we will have subpar monsoon as well.
Okay, one thing was for sure, the rupee reacted quite a bit yesterday post that repo rate cut. It went all the way to 69.16. It was the low point of trade. 1% move just in one trading session. But what about today? Bhaskar Panda of HDFC Bank says the dollar-INR pair has remained volatile because of local factors. Movement in near-end premia and spot movements seemed interrelated. He expects volatility to remain for the day, sees the pair trading in a range of 68.80 to 69.15.
I think Bhaskar is making a very important point that it went up on local factors. I mean, the dollar went up on local factors. It's not quite related to the rate cut, I would think. It's because of this large exposure rule of RBI that there has been some volatility. Today, perhaps all that is ironed out and we will see the dollar rupee reacting to fundamentals. On bond market, Bhaskar Panda says yesterday the Reserve Bank cut 25 basis points as was expected but kept the stance neutral. The 10-year benchmark bond yield moved up to reflect that. He expects the bond yields to trade within the range of 7.32 to 7.38% for the day.
Okay, let's talk about the global cues. Here's Mangalam with the world view.
Well, there was some buoyancy on Wall Street yesterday with the Dow gaining about 150 odd points. The S&P posting its first 6-day streak in the last 14 months, and the Nasdaq was an underperformer. So why did the Dow gain? Well, there were talks of trade optimism, and at the same time, the highest weight on the Dow, which is Boeing, about 10% weight out there, gained not only on account of the trade talk optimism. There was also a report coming in from the Ethiopian air crash investigators saying that pilots weren't responsible for the crash. And at the same time, some commentary coming in from Boeing CEO as well. They're looking at a comprehensive, disciplined approach to fix the software issues. Why was the Nasdaq underperforming? Because Tesla was down by about 8%. The company missed its Model 3 deliveries for the first quarter. Apart from that, across the Atlantic, the European markets by and large were mixed. All eyes now protracted towards how Brexit developments pan out and how the Italian GDP grows as well, which was the key reason why the FTSE MIB index index was an underperformer in the Eurozone because reports suggest that the government could cut their GDP estimate from 1% growth to 0.1%. In Asia, the indices that are open, the Nikkei as well as the Korean markets, they are mildly higher. The Korean index is mildly off highs. The other major indices, Hang Seng, Shanghai as well as Taiwan, all of them shut on account of the Qingming festival. Oil is between $69 to $70 per barrel. The SGX Nifty indicates a mild green tick.
Okay, well, thanks a lot for that. A lot of Asian markets.
They must be celebrating Ugadi. I mean, Gudi Pada looks like Qingming festival.
Perhaps it is. I mean, the start of spring everywhere, right? All
yeah,
over.
there is a solstice, relation to it. It's quite possible. Yes.
Okay, so celebrations galore across the globe. But as hopes of a potential US-China trade deal grow, President Donald Trump says that the deal could be announced in as soon as 4 weeks. Take a look.
It's got a very, very good chance of happening. I think that it will be great for both countries. But it will be a much fairer deal for us because over the years we've lost a lot of money to China. China's done very well, and I don't blame China. I say it all the time. I don't blame China. I blame the people that sat right at this desk.
Okay. All right. Anyways, important part for us is within 4 weeks there could be a trade decision, a trade agreement. Here's another CNBC exclusive. Ruchir Sharma of Morgan Stanley Investment Management talks about the state of emerging markets. His top picks in the EM space and his global market outlook are also with us listening.
It's been a completely lost decade for emerging markets. Emerging markets are still well off their all-time highs, which were set back in 2007 in dollar terms. So yeah, we have had a nice tactical run out here, but that's again happening because the Fed has sort of gone on hold and global markets in general are up. But for the big picture is this, that whereas the US stock market has tripled in value over the last decade, emerging markets have given you exactly zero return, and that's very disappointing. But looking ahead, that could be the opportunity. I think that the emerging market index today is extremely distorted. There are 3 countries there, China, Korea, and Taiwan, which account for 60% of the entire index. I think that's a big distortion. So there are a lot of smaller and mid-sized emerging markets which have got neglected in this washout we have had for emerging markets over the last decade. So I would personally favor putting much more capital in those neglected countries, what I call the anti-bubbles in the emerging market trade. Now, Europe's been a case of serial disappointment over the last decade as far as data is concerned. But I just want to put something in perspective here about, we compare Europe, US, and Japan, and the US economy has done really well, and we think that both Europe and Japan have done quite poorly over the last decade in economic terms. But there's one statistic which I really want to put this in perspective here. In per capita income terms, Europe, Japan, and the US have grown at an identical pace for the last decade, and that is a huge statement. So what it really tells you is that the central problem in Europe and Japan is one of demographics, that their demographics are much worse than that of the United States.
Okay, that's the word coming in from Ruchir Sharma. But let's decode the RBI policy a bit more. We spoke about it yesterday at length, that 25 basis points rate cut stands unchanged. But what would the impact be today, Lata, on the bond yields, for example?
Well, actually, the bond yields, since the policy comes in the morning, the reaction is complete immediately. The markets were positioned for a more dovish policy. So yesterday, actually, the bond yields have jumped up by 10 basis points. It's a rate cut of 25 basis, and what you got was a yield rise of 25 basis points because the market was disappointed. They were expecting more dovishness than what the MPC did. Now, I mean, I take the MPC's worries on board. El Nino can have a very bad effect, and the fisc can bloat. Look at the way in which the rival parties are offering packages. So I take their stance, but we must remember that even now there is a huge gap between inflation, which according to the MPC itself is not going to rise above 3.8% for the full year. And the repo rate is starting at 6. I mean, look at the difference. It's over 200 basis points, even when we get to 3.8. Actually, up until September, we'll only be at 3. So, there is a very big real rate, and there is a genuine disappointment that, there isn't an accommodative policy stance But we've spoke to a lot of bankers. The yield market has not made money cheaper. It has made money more expensive. Now, when you spoke to the bankers, they're all worried that there is more demand for credit than there is flow of deposits into the system. And that's why they don't have the elbow room to pass on rates. Therefore, this is a rate cut. The 2 rate cuts are not going to make money any cheaper for anybody. Okay. Well, and for me,
that's pouring cold water on the enthusiasm of at least a couple of sectors like real estate, etc. One would have hoped that, you know, the cost of capital would fall.
Yeah, at the moment, at least 50 basis is a substantial amount in 2 months, but it looks like nothing will be passed on because the deposits are simply not flowing into the banking system. Okay. So perhaps they have to look for liquidity instruments. I would wait to see if they announce something different on liquidity, you know, more of those dollar swaps, more OMOs, so that you flood with liquidity and perhaps allow a little bit of... Anyway, for me, the big takeaway also is that yesterday, with the policy, the governor looked less like a North Block executive and more like a Mint Street Mandarin. I mean, once you come to Mint Street, you become more conscious about disciplined behavior.
Okay, well, that's interesting. But let's move on. Starting today, we launch our new series, Election and Market, in which we will analyze how past elections and successive governments have dealt with the issues around key sectors. So today, we start off with a deep dive into the banking sector, its performance over the last decade, and the priority list for the new government. Joining in will be 2 veteran former bankers, S.S. Mundra, A.K. Purwar, as well as the money market expert Neeraj Gambhir. Do stay tuned in. This special show is lined up 10 a.m. onwards.